Hey everybody, it's Randy Wolfe. Hope you're having a great day. Welcome back to the video series. This 12-part video series is covering all the ins and outs of what a new real estate investor or aspiring real estate investor needs to know. And you are watching video 3 in the series. So if you haven't watched the first 2, be sure to go back and watch those, as we are now diving into which market you should invest in, how you kind of figure out how you're going to invest in which market. So let's dive in. So location can really make or break a real estate deal. You know, whether you're going to fix and flip, whether you're going to use the BRRRR strategy, whether you're going to keep rentals, that sort of thing, whatever you decide is very, very important. And that's what we talked about in video 2. But in this video, I'm going to tell you that your market is even more important than the strategy that you're going to use investing in real estate. And what do I mean by that exactly? Basically, if you think about it, let's say you're going to fix and flip and you find a pretty good deal. Like, let's say you're going to use, without getting too technical here, you're going to be buying houses at roughly 70% of ARV minus repairs. That's kind of your number you're shooting for. And you buy a property in a bad market. That, even though you're getting at a good rate, so to speak, a good price point, if you're in a bad market, you're going to potentially sit on that property for a long time for it to sell. And that's going to cost you a lot of money. Plus, it may be that it's such a rural area, it's hard to get a contractor out there to actually do the work. There's so many challenges when you're not in a good market. And I'm not just necessarily talking about city versus rural, but the point of it being, you want to make sure the market that you invest in is a solid market. What does it look like? Is it people moving away from that market? Is the population shrinking? Like, those are things you need to really be sure you look at. So as crazy as it sounds, you have the ability to invest in a local market like your backyard, or you can invest in a remote market, not your backyard, like in another county or another state. It sounds crazy when you think about it. I mean, the day and age we live in now, you can literally buy a property. I live in South Carolina. I can buy a property in California and have management in place to manage the property and do everything that needs to be done and not even have to do any, I mean, like, it's so easy now with internet access and that sort of thing. It's very simple. It's not easy. So you have to have very, very strong systems and processes in place if you're going to invest remotely. You have to have a very good team. And when I talk about team, I'm talking about real estate agents, title companies, contractors. All of those things are critical. You have to have that. I talk in another video about how important it is to have a really solid team in place. So when you're investing remotely, it is even more critical to have that strong team in place and good property management, because it can really eat you alive if you don't have those things in place. Now, when you're investing locally, there are things that you can do yourself. So you can go drive out and look at that property. You can go out and fix that leaky faucet if you want to. I'm not saying you should. You're at a place to where you're able to kind of do some of the things, roll your sleeve up and kind of do some of those things. It makes it a little bit easier when it's local. I would argue if you invest locally, you're more prone to do those things, and maybe you shouldn't be doing them. You should be using your time in its best and highest use. And so it really depends on your local market. Is it a good market to do the strategy that you're considering? And again, we talked about in the last video, flipping properties, wholesaling, rental properties, or BRRRR strategy. Like, is your market conducive to doing one of those things that you choose? And if the answer is no, I would argue you shouldn't invest in your local market. You should invest either somewhere maybe within your same state, but somewhere else, or potentially out of state altogether. If you look at some of like the Midwest, like a lot of those, you have cash flow in rental properties are a lot better, your cash on cash return, versus if you're investing somewhere like California. On the flip side of that, if you're looking to really build wealth and looking at appreciation, somewhere in California is going to typically appreciate faster and more than somewhere in, a rural part of the Midwest. So it really goes back to what is the reason you're investing, what is your overall goal and your strategy. So there are a few key factors that dictate whether a market is investor friendly or not. Historically speaking, regardless of your political affiliation or what you like, typically red states are a little bit more investor friendly than blue states. That's just the way it is. Whether or not you're Democrat, Republican, or whatever, that's your business. But typically red states are a little bit more friendly when it comes to like landlord tenant laws and things of that nature. But there are 5 things that I really want you to consider when you're looking at investing in a market: population growth, job growth, landlord friendly states, affordability, and 5th, demand. Those are the 5 things that I really want you to focus on when you're looking at a market to determine whether or not that market is a good market for you to invest in. By the way, real quick, if you feel like so far this video is helping make things a little bit clearer for you, be sure to subscribe to our channel and click that notification button. This is a part of a 12-part video series, and I want to make sure that you get these extra videos as they're released. And also every single week, the videos that I'm releasing every week, there's a lot of great content that I think will really help you. And also while you're at it, be sure to smash the like button if this video is bringing value. All right, so the next thing is, how exactly do you research these markets? What is it that you can do? What sort of tools can you use? And I will tell you, there are a lot of free tools that you can use that can really be beneficial to help you. Free tools that you can use are census.gov. That's one where you can look at data. You can use Zillow, you can use Redfin, you can use realtor.com. All of those are free tools that you can use that can really help you understand a lot of these 5 factors that I mentioned before, give you kind of an understanding of what's going on in that particular market. Another software that you can use that I use personally, and I strongly recommend considering, is PropStream. PropStream is a paid service, but you're able to go in there and you can do serious list building. You can segment lists. You can look at, just for example, certain houses and certain zip codes that are owned by, let's say, non-owner occupied owners. So like typically like landlords. I do a video on this channel about tired landlords and how you can market to them to try to find really good deals. There, you can look at vacant houses. You can look at properties if they have a lien. You can look at properties that are in pre-foreclosure, all of those things. So I'll put a link in the description below for PropStream. Again, that's a paid tool, but you can utilize a tool like that to try to help you kind of sift through and figure out whether or not a market is a good market to consider. A couple of other free tools is Rentometer. They have like a free version, but it's also, the paid version is a little bit better, so you can check that out, Rentometer. And then you can look simply like Google Trends. You can find a lot of information about an area in just by looking at Google Trends. So what are some of the red flags that you should look for? Well, a red flag, particularly, let's say if you're going to be a buy and hold person where you're building a rental portfolio and you're especially in the early phases where maybe you don't have a lot of money, is high priced properties with a low rent. That can be dangerous. Now, oftentimes, not always, but a lot of times, if a property is bringing in, if it's a low price property that is bringing in higher rents, you've got to make sure that you're not dealing with a bad area. So a lot of these like D-class properties, the cash flow can look better on paper, but once you start dealing with all of the issues with, torn up properties, vacancies, those types of properties, you actually can lose money in the form of having to constantly repair like damages and stuff like that. So be looking out for those things, but you don't want a property or a market where it's like crazy high prices and low rents. It's overdeveloped. That's also can be a challenge if it's overdeveloped, because then you're competing with all of these new units. And as I mentioned before, anti-landlord laws, like these states that have these difficult laws, for example, going back, if you recall, during the pandemic, we had these situations, certain states where, the landlord couldn't evict the tenant, and so tenants were taking advantage of that and not paying for months and months and months at a time. You want to be able, if the tenant stops paying and refuses to pay you want to be in a state where you can legally take action to evict that tenant, so that you're not just sitting there paying a mortgage and continuing to own a property that you're not getting rent for. So if you're looking at rental properties, there is a good rule of thumb that I'll tell you about. And again, it's a rule of thumb. It's not the be-all perfect thing. It's just something you can look at, and it gives you an idea of whether or not that property is going to potentially cash flow and make a lot of sense. And it's called the 1% rule. And so basically the 1% rule states that if the rent is 1% or more of the purchase price, then there's a good possibility that that property can make sense as a rental. So basically, again, you just look at it. If you're going to pay $200,000 for a property and you know that that property can rent for $2,400, then that beats the 1% rule. It's worth diving in and crunching your numbers even more. Things that can have an impact on this are like certain areas, certain towns, cities, zip codes. Taxes can be in those counties can be kind of segmented and all crazy. Like in South Carolina, in one county, you could have an area where the taxes are a lot higher than in another area. So you need to look at all of those factors. But again, the 1% rule can give you an idea. If you look at a property and they're wanting $300,000 for the property and it's only going to get $900 a month, I can tell you that property is not going to cash flow if you have a loan, unless you just put down a substantial amount down, which again, then your cash on cash numbers look bad. So be looking at that, use that kind of as a gauge or a rule of thumb. But again, you have to still do your due diligence and do your in-depth underwriting. When you're looking at markets, sometimes some of the absolute best markets are the markets outside of the big cities, kind of in the suburbs. Like, so for example, on the outskirts, everybody is familiar with Atlanta, Georgia. So trying to invest in downtown Atlanta, Georgia is going to cost a lot of money because real estate is very expensive. But if you get outside of Atlanta a little bit to where people can potentially commute to work in downtown Atlanta, then there are pockets to where you can find real estate that makes a lot of sense. Here in South Carolina, you know, as I mentioned on another video, like I typically invest in about an hour and a half circle, or radius, I should say, around Columbia, South Carolina. So I'm investing in those areas. Whenever I was flipping land and doing some of that, you know, I'd invest all over the country for that. But when it comes to houses, I'm typically investing in about an hour and a half radius. I do buy all over South Carolina. I have houses that are farther than that away. But typically, if I'm going to buy outside of that radius in South Carolina, I'm going to want to make sure it's a very, very lucrative deal for me. I'm going to buy it a lot deeper, and I want to be in a position to where if I decided to sell it tomorrow, I could buy it today, sell it tomorrow, and be able to sell it as is and make a profit. So that's kind of how I gauge when I'm looking at properties here in South Carolina. But again, when you're first getting started out, I would encourage you to have a very tight buy box as far as exactly where you buy, what you buy, because if you have this really big buy box and you're like buying everything, it's really hard to be efficient with your underwriting, and it just gets to be too much to try to manage. So at the end of the day, if you do decide that you're going to invest out of state, as I mentioned before, you really need to have a strong team around you. So one of the key assets that you need is a good, solid real estate agent. It may take you trying to work with a couple of real estate agents in that market before you find a really good one. But working with a good agent that's going to really be your boots on the ground, your eyes on the ground, is so important. Another asset that you really have to have, especially if you're doing rental, is you have to have a good, solid property manager. Property management, I have a video on the channel about property management, but property management can absolutely drive you crazy. If you have a bad property manager, it can cause you to have a very, very bad experience, and it can cost you a lot of money. So when you're managing properties, you know, if it's local, it's a little easier to do that on your own. But if you're investing far away, like, you really, really need to have a good property manager. So you also want to leverage your property manager, if you have a good one, or your real estate agent, to find good contractors. So if you're working with an investor-friendly real estate agent, and oftentimes your property manager will know contractors in the area. And so you need to leverage these relationships that you're building and kind of utilize them and their knowledge of the area to find other relationships. So a really, really good real estate agent can actually connect you with a really strong property manager, and a really strong property manager can connect you to a really strong contractor or two, and that can make all the difference in the world for your success if you're investing in an outside, you know, investing from a distance, or really even if you're investing locally, building those relationships are essential. So finally, when you're really looking and you want to narrow down your results, finally, as you're looking at all of your places that you're considering investing in, you want to start to get a more narrow lens of where you're looking. So I would start out kind of broad, and then I would zoom in for data and get closer and closer down to maybe even like 1 or 2 zip codes, depending on where you're investing, how big and populated that is. But basically, you want to have a really tight area or two to where you can dive deep and understand all of the fundamentals of that area. Learn all about the different neighborhoods, learn all about what properties are selling for, learn all about rent rate, all of those things, because that stuff changes and evolves. And if you're trying to be way too broad, it's going to be hard to keep up with all of that. So you want to start somewhat broad, but then gradually narrow down until you can really establish your area. Now, it's okay once you have experience and you've been having success investing in real estate, it's okay to expand your area. You can zoom back out and open that up a little wider, but in the beginning, it's a little bit more helpful, and I would advise to really kind of have your area, your market sort of tight, so you can really focus on that particular area and know the ins and outs of it. All right, now that you've got your area locked in, hopefully, it's time to talk about money. Show me the money. How are you going to fund these deals? And that is exactly what we're going to cover in video 4. So be sure for video 4, you've got a notepad and paper, because you don't want to miss it. Thanks for watching again. I appreciate you being here today, and I'll see you on the next one.